Welcome to the Ontario Mortgage and Real Estate Insights podcast, your go-to source for the latest developments, trends, and regulatory changes in the industry. I'm your host, Steve Hamoan, here to provide you with insights sourced from reputable news outlets to help you stay informed and make well-informed decisions.
This podcast is brought to you by Real Approved Inc., a trusted mortgage brokerage dedicated to helping Canadians achieve their home ownership dreams. Visit realapproved.ca to learn more about how our experienced team can assist you with your mortgage needs. Let's dive into today's episode.
Today, we're discussing an interesting development in the Greater Toronto Area's housing market. Janine, it seems like there's some good news for potential homebuyers out there.
Absolutely, Steve. According to Kaylee Heaps, President and Chief Executive Officer of the Heaps Estrin team, it's a great time of entry for homebuyers in the GTA. The average price of a home fell more than 5% in June compared to last year, which is making homes more affordable for buyers.
That's right, Janine. The data from the Toronto Regional Real Estate Board shows that the average selling price in the GTA dropped by 5.4% year over year in June to just over $1.1 million. For those looking to enter the market, this could be an opportune moment.
It's not just about the prices, though. The market is showing some signs of recovery. Seasonally adjusted home sales were up by more than 8% from May, which suggests that buyers are starting to gain confidence again.
Heaps mentioned that the first half of 2025 was marked by economic and political uncertainty, which kept many potential buyers on the sidelines. But with these recent changes, it seems like the market is starting to stabilize.
And Steve, it's important to note that factors like a potential trade deal with the United States and interest rate cuts by the Bank of Canada could further aid the market's recovery. These elements could definitely boost consumer confidence.
Indeed, Janine. The central bank has kept its overnight interest rate steady at 2.75% after a series of cuts last year. Even though more cuts might be needed, the current rate environment is more favorable than it has been in years, making it a more affordable time for buyers.
Kaylee Heaps really emphasized how affordability has improved and how now could be a strategic time for buyers to act. For many in the GTA, this might be the moment they've been waiting for to enter the housing market.
Let's talk about the recent mortgage delinquency rates across Canada. Saskatchewan is currently leading the provinces with the highest mortgage delinquency rate. However, it seems like the situation is more complex than it appears on the surface.
Yes, Steve. Saskatchewan's delinquency rate stands at 0.37%, which is indeed the highest among the provinces. But what's interesting is that despite this, the situation there is reportedly improving compared to 5 years ago.
Exactly, Janine. According to Rebecca Oakes, the Vice President of Advanced Analytics at Equifax, fewer people in Saskatchewan are missing their mortgage payments now compared to 5 years ago. This suggests that while the numbers are high, there's a downward trend in delinquencies.
And that sounds heartening, Steve. It's a reminder that even when things seem bleak, there's often more going on beneath the surface. But we can't overlook the rising delinquency rates in Ontario and British Columbia, which are becoming a growing concern.
Right. Ontario is seeing significant increases, with the delinquency rate at 0.19%. This is a record high for the province, as noted by Oakes. The economic challenges, including affordability issues, are quite pronounced in Southern Ontario and British Columbia.
It's a tough situation for many homeowners. The financial strain from higher mortgage renewal rates, alongside inflation making everyday expenses like groceries and gas more costly, is really taking a toll.
Matt Fabian, Director of Financial Services at TransUnion Canada, mentioned that many are experiencing what's called payment shock when renewing mortgages at rates much higher than during the pandemic. It's a significant jump that can double or even triple their payments.
That's right, Steve. And it's not just the rate hikes. Inflation is adding another layer of difficulty. This combination is putting extra pressure on both home buyers and sellers, especially with the uncertainty around U.S. tariffs affecting economic stability.
Analysts, including Fabian, are closely monitoring how mortgage renewals, rate cuts by banks, and U.S. tariffs might influence these trends. The hope is that as interest rates and inflation eventually stabilize, so too will the delinquency rates.
It's crucial for us to understand these dynamics and prepare accordingly. For those like Tyler Franson, who lost his home in Saskatchewan, it's a painful experience, but he's trying to find solace in the ability to focus more on his family now.
Franzen's story highlights the human aspect of these statistics. While it's essential to look at the numbers, we must remember the real people behind them and the challenges they face.
Absolutely, Steve. It's about empathy and understanding as much as it is about data. We need to keep these stories in mind as we navigate the complexities of the housing market.
All right, Janine, let's move on to our final topic of the day, which focuses on the implications of anticipated interest rate cuts and their potential impact on mortgage demand. Equifax has been monitoring these trends closely, and they have some intriguing insights to share.
Yes, Steve. Equifax's data suggests that potential interest rate reductions could significantly alter the dynamics of mortgage financing. They are forecasting a possible resurgence in first home buyer activity, despite a recent decline in demand.
According to Equifax, the demand from first home buyers has fallen by 6.6% year-to-date compared to 2024. However, they project a possible turnaround with up to a 3% growth in the second half of 2025. This could be driven by expected cuts in the cash rate, which would improve affordability and restore confidence.
It's interesting to note that while first home buyer activity has been subdued, refinancing demand has actually grown by 8% year on year. Homeowners are actively seeking improved loan conditions amidst rising costs, which is a smart move considering the current economic climate.
Equifax's modeling suggests that a forecasted rate cut in July, whether it's by 25 or 50 basis points, could lead to a 14% increase in new mortgage inquiries and a 16% rise in refinancing within just 3 months. Moses Samaha, the executive general manager at Equifax, mentioned that this indicates the market's responsiveness and a potential trend among first home buyers as confidence improves.
Refinancing activity is already quite elevated, with inquiries making up 36.2% of mortgage demand in May. Among sole traders and small and medium enterprises, this figure climbs to 48%, reflecting the financial pressures many businesses are facing.
Investor participation in refinancing is also noteworthy. Equifax data shows that 40% of investor-related refinancing demand originates from New South Wales, followed by Victoria at 26% and Queensland at 19%. This demonstrates the varied financial strategies across regions.
It's encouraging to see indicators of growing confidence in the market. Equifax reported a 13% year-to-date rise in early-stage mortgage access intent, with May alone showing a 17% increase compared to a year earlier. This suggests that as conditions potentially improve, more people are considering entering the market.
And by age group, it's notable that the 65 and older bracket recorded the largest increase at 24%, followed by 18 to 25-year-olds at 20%. These demographics show a wide range of interest in capitalizing on potential rate cuts.
Absolutely, Steve. Equifax's data suggests that while recent conditions have dampened activity in some mortgage segments, further cash rate reductions could drive renewed demand, especially among buyers and borrowers seeking relief from cost pressures.
It's clear that the landscape of mortgage demand is complex and ever-changing. As we continue to monitor these trends, it's crucial to remain informed and prepared for shifts in the market. Thanks for tuning in to another episode of the Ontario Mortgage and Real Estate Insights podcast. We hope you found today's insights valuable as you navigate the world of mortgages and real estate.
Before you go, a quick reminder, Real Approved is here to make your mortgage journey smoother. Whether you're buying your first home or refinancing, their experienced team is ready to guide you with personalized support every step of the way. Visit realapproved.ca to get started and take the next step toward achieving your homeownership goals. Catch you next time and stay informed with the latest industry insights.